Most business owners don't overpay capital gains taxes because they made bad investments. They overpay because no one helped them plan the sale before it actually happened. You can sell the right assets, make great moves, and still write a massive check to the IRS. You didn't need the right. So today, I'll show you why business owners overpay capital gains taxes and how to stop it legally. If we haven't met, my name is John Rojas. I am a certified financial planner, and I work with business owners to reduce taxes, to build wealth outside the business, and to protect what they're building. If you have any questions at all, drop them in the comments below. I read all of them, and if you want personalized help, there's a link down there to book a call with me. So what is a capital gains tax? Capital gains tax is simply the profit you make when you sell an asset for more than what you paid for it. Let's assume you buy something for $300,000. You sell it for $400,000. That $100,000 difference, it's a capital gain. And the IRS, well, they want their fair share. Now, this is going to apply to investments, to real estate, to business transactions, to stocks, and also to crypto. And there's two forms of capital gains. There's a short-term and long-term capital gains. And here's where people really overpay. And here's where most business owners get hit the hardest. Hold an asset less than 1 year and gains are taxed at ordinary income tax rates up to 37%. If you hold it longer than 1 year, you qualify for long-term capital gains, which is much, much lower. In fact, in 2026, long-term capital gains rates, if you're married filing jointly and you make under $98,900, zero capital gains. You make under $613,700, 15% capital gains, and anything above that, you're paying 20% in capital gains. Now, if you're a single filer and you're making under $49,450, 0% capital gains. To be in that 15% long-term capital gains bracket, you have to make under $545,500 as a single person, and anything above that, you get hit with a 20% long-term capital gain. Now, high-income business owners may also owe that 3.8% net investment income tax on top of those capital gains. But here's a planning note for you. If you need cash but don't want to trigger capital gains, you may be able to borrow against your investment account instead of selling. That's planning, not avoidance. So why do business owners overpay? Most business owners don't overpay because they're careless. They overpay because decisions are made in isolation. Before you sell anything at all, I want you to ask yourself, should this be sold now or deferred? Is there a better structure? How does this affect my long-term plan? That's the difference between reacting and planning. Now let's move on and cover some strategies you can utilize to reduce or possibly eliminate your capital gains. These aren't all the strategies, but these are the most common ones for you to consider. Strategy number 1, 1031 exchanges on real estate. If you own investment real estate, a 1031 exchange allows you to sell one property, reinvest it into another, and defer capital gains taxes. An important note most people miss: if you 1035 into a property, you can't move into it right away. To preserve the tax deferral, the property must be held as an investment, generally for at least 2 years. After that period, it may later qualify under primary residence rules, but timing does actually matter. Strategy number 2, step up in basis. This is one of the most powerful and most misunderstood tax benefit still around. Let's say your parents bought the house you grew up in for $350,000. Over time, even these days, it's appreciated and now that home is worth $1.5 million. If they don't sell and you inherit the home, the IRS treats it as if you paid $1.5 million for it, its current market value. That's what's called a step up in basis. So if you inherit the house and sell it right away for $1.5 million, your cost basis, $1.5 million. Your sale price is $1.5 million. The result, zero capital gains tax due. This applies to taxable assets, not retirement accounts or annuities. And a costly mistake I see all the time. People get added to their parents' home while they're still alive, thinking it's good planning. In reality, that can destroy the step up in basis, and that's a painful way to lose an incredible benefit that still exists today. Strategy number 3, the Roth 401k strategy. I love this strategy. Got a lot of videos on it on my channel. Many business owners think a Roth strategy doesn't apply to them. They're absolutely wrong. In 2026, if you're under 50, you can put $24,500 into a Roth 401k. If you're over 50, you can do $32,500. And if you're the ages between 60 and 63, you can put up to $35,750 if your plan allows for it. Money inside a Roth grows tax-free. It also comes out tax-free and avoids capital gains entirely. Over time, tax-free compounding is an incredible and powerful tool. Sure, some of you're going to comment below and you say, well, John, you're going to get taxed up front. And that's true. But if you hold it long enough, you can withdraw every cent over time completely tax-free. Strategy number 4, tax loss harvesting. Assume you buy stock A for $10,000. You buy stock B at the same time for $10,000. Later on, stock A is worth $5,000. You lost $5,000. Stock B, it's worth $15,000. You made $5,000 on stock B. You sell them both at the same time or in the same tax year. Gain and the loss, they cancel each other out. 0 capital gains tax. Losses aren't bad. They're tools when used correctly. Strategy number 5, primary residence exclusion. Let's say you bought a house for $500. It's now worth $1 million. You're married. That's a $500,000 gain. If it's your primary resident and you've lived there for 2 out of the last 5 years, you can sell and pay 0 capital gains tax. Strategy number 6, charitable giving. Here's an example. Let's say you bought $10,000 worth of NVIDIA. It grew to $500,000. You sell it, you're going to pay long-term capital gains tax. But donate the shares, no capital gains tax, plus a charitable deduction. That's efficient generosity. Now, common ways my clients do this is through donor advised funds, but there are other vehicles like charitable remainder trusts. If you're charitably inclined and want to explore options, book a call using the link below. Happy to see how I can help you. Strategy number 7, health savings accounts. HSAs are one of the most overlooked tax tools. For 2026, if you're single, you can put $4,400 into an HSA. If you've got a family, you can put $8,750 plus $1,000 catch-up. The biggest mistake is spending it early. Used correctly, an HSA becomes one of the best tax-free accounts available. The key to paying less in capital gains taxes isn't avoiding taxes, it's planning ahead. As a certified financial planner, my job is to look at the full picture, design the right strategy for your situation, and coordinate the right professionals. If this helped, like, subscribe, and drop a question below. Thanks for watching, and I'll see you next week.